Okay, the second question on the final exam from fall of 2019 is a statement of cash flows. This is, you're given a summary income statement as well as a comparative balance sheet. So you're going to be given columns A through D. And then you're told that common stock was issued for cash, and the only items affecting retained earnings in the year were net income and dividends declared and paid. So this is to do the indirect method of, it says here, use the following select data and additional information to produce the statement of cash flows using the indirect method. So we start with net income. So net income from the income statement here, row 14, is $19,000. To that, under the indirect method, we're then going to make a series of adjustments to reconcile net income to net cash provided by operating activities. The first one is depreciation expense. Depreciation expense is $37,000. And that is also confirmed by the increase in accumulated depreciation on the balance sheet. So that's a non-cash item, so we're going to add that back. Depreciation lowered net income, so we're going to increase net income by that amount. Then we're going to increase or decrease the net cash flows from operating activities based upon current assets and current liabilities, the changes in working capital. So current assets have an inverse relationship to operating cash from operating activities. So as accounts receivable goes up, you see it went up by $8,000, increased from $37,000 up to $45,000. That decreases cash because if accounts receivable is going up, you're not getting paid. So that is a decrease in cash. Conversely, decreases in inventory and prepaid rent. You're not buying more inventory and you're not paying any more prepaid rent. So that increases cash because you're not using cash to buy new inventory. The current liabilities, on the other hand, have a direct relationship to cash. So accounts payable went up by $3,000. It means you're not paying your vendors, just like your customers are not paying you, you're not paying everybody else. So that went up $3,000. That's an increase. Other accrued liabilities went up $3,000. That's accrued payroll, wages payable, taxes payable, things like that. And then you did pay, however, income taxes. If you add up that whole column from the 19, the 37, minus the 8, on down to minus the 1, you get $62,000 of net cash provided by operating activities. So what that did was that took care of all of this plus all of this, and this, as well as this. All right. So investing activities is any changes in the rest of the asset side of the balance sheet. So that is the land went up $37,000. We'll just make that blue. $39,000 increase in land, and plant and equipment went up $74,000. There were no disposals, so those are purchases. So we had net cash used in the, actually highlight all of this in yellow. There we go. Net cash used for the acquisition of land, $39,000. Net cash used for the acquisition of new plant assets, $74,000. So net cash overall total used by investing activities, 113,000. And then lastly, that leaves us the rest of the liability section, of which there was no change in long-term notes payable, and then the stockholders' equity section. And we'll make this orange. So common stock increased by 49,000. And under additional information, we're told that common stock was issued for cash. So that is additional cash derived from the sale of stock. And then retained earnings went up 15,000. And in the additional information, it said the only items affecting retained earnings were net income and dividends declared and paid. So if retained earnings went up 15,000, but net income was 19,000, the difference between those two is dividends. So cash payments of dividends, $4,000, which gives us net cash provided from financing activities, 45,000. So that is the 62 minus the 113 plus the 45 is a net decrease in cash of $6,000, and sure enough, the cash balance at the beginning of the year was 21, and at the end of the year, it was 15. We'll go ahead and move on to the last question, and that is you'll be given a comparative income statement and a comparative balance sheet for a publicly traded company. This year it was Kellogg Company, the maker of cereals, and you're asked to do the 10 ratios for financial statement analysis. All right, so starting with the current ratio is total current assets is the numerator. So the 3.157 billion. The denominator is total current liabilities, which is right there. That will give you a value of 0.70. The denominator, well, and then once you have that, you can subtract the current assets from current liabilities, and you get a negative working capital of 1,372,000. Ratio number 3, the denominator is the same. The numerator is everything out of current assets that could be turned into cash quickly. So turned into cash quickly is cash and cash equivalents and short-term, any marketable securities, which there was 0, and then net receivables. So the sum of all that, and that gives us a acid test ratio of 0.33. Accounts receivable turnover, the numerator is total revenue. So total revenue, and then the denominator is average accounts receivable. So accounts receivable from the beginning of the year added to accounts receivable at the end of the year divided by 2. And that gives us 11.4 as our calculated value. That then becomes the denominator for number 5. Divide that ratio into the number of days in the year, 365, and you get a average day number of days sales in receivables of 31.9. Inventory turnover, the numerator is cost of sales. So cost of revenue, and that is related to inventory. And you take the inventory at the beginning of the year, add it to the inventory at the end of the year, divide it by 2, and you get 7.3, which becomes the denominator for number 7. So Kellogg's holds about 50 days of inventory, 50 days of sales in inventory at any point in time. Return on common stockholders' equity. The numerator is net income. The denominator is average stockholders' equity. So just like we've been averaging accounts receivable and inventory, we're going to average the total stockholders' equity. So that's these two numbers right here. And that gives us a 30%. And this is the only one of the calculated values that is normally expressed as a percentage. So debt to stockholders' equity, numerator is total liabilities. Denominator is total stockholders' equity, which we had from the row above. And that gives us a 5.6. So for every dollar that the shareholders of Kellogg's has at risk in the business, the debtors, the people who lend Kellogg's money, have $5.60 at risk. And then the last one is number of times interest charged earned. We have an earnings before interest and taxes from the summary income statement. And we have total debt, interest expense as the denominator. And so they have earned, they have enough net income in order to pay their interest 4.6 times over. All right, and those are the 3 questions that make up the final exam.